A lot of people think financial freedom is some big, far-off goal, but the truth is, it can start with something as simple as a $10 a day habit if you're investing it the right way. Over the past few years, I've made dozens of videos showing exactly how to build dividend income step by step with real numbers, real portfolios, and real outcomes. So in this special compilation, I've pulled together the most helpful and most practical moments from 6 of those videos. You'll see how $10 a day can grow into $60,000 a year in dividends, which dividend aristocrats are actually beating the market, and how a simple 3 ETF strategy can turn a $10 daily investment into a $1 million portfolio. If you follow closely, you'll start to see a pattern. A clear, repeatable way to make your money work harder than your job ever could. Let's kick it off with the basics. How to invest in dividend stocks for beginners in 2025. How do I start investing in dividend stocks? What exactly are dividends? How much money do I need to begin? Which stocks should I pick and when do I buy them? And most importantly, how do I make sure I'm not making a huge mistake with my money? If you're asking these questions, don't worry, you're not alone. In fact, these are the exact questions I'm going to help you answer in this video. I'm diving into the basics of investing in stocks, breaking down everything from understanding what stocks are to choosing the right investments. Whether you're just starting out or need a refresher, I'll answer your questions about brokerage accounts, stock tickers, market orders, and more. Plus, in the end, I'll show you and John how you can combine everything to create a well-diversified portfolio that can turn your $10 daily investment into a portfolio valued at around $3 million, with $60,000 in annual dividends equating to roughly $5,000 in monthly dividend income. First, let's clarify a few things about investing in dividend stocks, because investing isn't just for Wall Street professionals or billionaires, it's for anyone who wants to take charge of their financial future. Whether you're aiming to save for a house, a vacation, or just a comfortable retirement, investing can help you reach those goals faster than any savings account ever will. The key is to start and keep going. It's all about making your money work for you instead of the other way around. All right, now that I've got your attention, let's get to know stocks. In simple words, stocks are just a way to own a tiny piece of a company. When you buy a stock, or in finance terms, when you invest in a stock, you're not just throwing money into the void, you're actually becoming part owner of a business. Every time they do well, you do well. How? Well, let me explain. A stock is a piece of paper that represents a claim on a company's assets and earnings. When the company does well, whether it's making more money, launching new products, or expanding to new markets, its stock price tends to go up. And when that happens, the value of your little slice increases as well. But stocks aren't a get-rich-quick thing. There's always a little risk involved. The value of a stock can go up, but it can also go down. The key here is that stocks are an investment for the long term. So long as you're patient and keep a steady hand, the market tends to reward those who stay invested. Another thing that can come attached with stocks are dividends. These are called dividend stocks. They're like little bonuses that companies pay out to owners of the stocks. If you own a stock that pays a dividend, you'll receive a payout, typically in cash or sometimes in additional shares. These dividends are usually paid quarterly. So how can you invest in a dividend stock? Well, that's the next thing we're going to cover. I'm going to tell you how you can get started with investing even if you're not exactly swimming in cash right now. The first thing you and John need to start investing is a brokerage account. Think of it like your investment shopping cart. You'll use it to buy and sell stocks just like you would when buying something online. For stocks, I've partnered with Moomoo. It's an app that allows you to trade stocks, options, and ETFs from your laptop, iPad, or your phone, and they don't charge any commission fees, unlike some other brokerages that do.
Moomoo offers powerful free features like financial analysis, market monitoring tools, and conditional orders, helping you spot bullish stocks and potential investment opportunities. New users can earn up to an 8.1% APY on idle funds for 3 months and enjoy a generous welcome bonus, including up to 15 free stocks and a 1.5% cash reward up to a $300 maximum on initial transfers. Sign up using my link in the description, make a deposit, and take advantage of these amazing rewards. Don't miss out on this opportunity to enhance your trading experience with Moomoo. Once your account is set up, you can link it to your bank account and start depositing funds. If everything goes smoothly, you can start with investing as little as $10 a day. And if you choose a stock like Home Depot with consistent investing habits, in 30 years, that initial daily contribution will turn into a massive $3 million portfolio. If you want to know how I got these numbers or how I selected Home Depot as a stock investment, then stick around till the end, because I'm going to tell you and John all about it, and along the way, show you similar stocks and a portfolio that can turn your $10 daily investment into a $3 million portfolio. Now, to really make sense of all the stock numbers and terms, you've got to understand how the stock market actually works. First up, let's talk about ticker symbols. These are like the stock's nickname, a short code used to identify a company on the stock market. For example, Home Depot's ticker symbol is HD, and Coca-Cola's is KO. Whenever you search for a stock, you'll see these abbreviations everywhere. It's your way of quickly recognizing a company without having to type out the whole name. Next is market orders versus limit orders. This is a big one. When you buy or sell stocks, you can place either a market order or a limit order, and each has its pros and cons. A market order means you're buying or selling immediately at the current market price. It's fast, it's simple, and it ensures you're in and out quickly. But sometimes you may end up paying a bit more or selling for a bit less than you were expecting. That's just the way the market works. On the other hand, a limit order is where you get to specify the exact price at which you're willing to buy or sell. If the stock hits that price, the order goes through. If it doesn't, well, you can wait, adjust your price, or cancel the order altogether. This gives you more control over the price, but there's no guarantee the trade will execute immediately or at all if the stock price doesn't hit your desired number. Next, let's talk about bid and ask. When you see a stock listed on your broker platform, you'll see two prices, the bid and the ask. The bid is the price that buyers are willing to pay for the stock, while the ask is the price that sellers are asking for. The difference between the two is called the spread, and it can tell you a lot about how liquid or easily tradable a stock is. The tighter the spread, the more liquid the stock. Wider spreads, on the other hand, may indicate less liquidity, meaning the stock isn't being bought or sold as frequently. Stocks of large, well-established companies like Apple or Microsoft usually have high liquidity, meaning there are plenty of buyers and sellers. For smaller or less popular stocks, liquidity can be lower, which might make it harder to enter or exit a position without impacting the price. Which order you use and which company you choose to invest in really depends on your investing strategy, the company's metrics, and a bunch of other factors that I'll break down for you so you can make smarter, more informed choices. Alright, so now that you've got a handle on the basics, let's get to know how you can use all this knowledge for dividend investing. If you're someone who likes the idea of earning money just by owning stocks, then this could be a great strategy for you. Let's take a look at a real-life example to better understand how these market mechanics and market dynamics come together with Hawthorne Bank shares with the ticker symbol HWBK. So this is a small regional bank with a relatively stable market position. Let's say you're interested in buying stock in Hawthorne Bank shares, and you look at the bid and ask prices. Let's say the bid price might be $20.10 and the ask price is $20.15. Just a small spread between them showing decent liquidity. Now, if you want to place a market order, you'll get in at the current market price of $20.12. But if you're looking to save a few cents, you might choose a limit order at $20.05 to wait and see if the stock drops to that price. On top of this, Hawthorne Bank Shares pays a dividend of about 19 cents per share quarterly. So if you owned 100 shares, that's $19 every quarter coming your way, whether you do anything or not. That's the beauty of dividend investing, getting that regular income stream while your investment could still appreciate over time. By understanding these mechanics like ticker symbols, orders, bid-ask prices, and dividends, you're already setting yourself up for smarter investing decisions. And with stocks like Hawthorne Bank Shares, you can see how these concepts play out in real time. Let's say you and John invested $10,000 in this company and reinvested all your dividends. After 30 years, your portfolio could be worth over $1 million. And here's how it could play out. After 1 year, your portfolio would be worth $11,349. After 10 years, your portfolio would be worth $37,657. After 20 years, your portfolio would be worth $171,738. Fast forward to 30 years, and you could be earning more than $100,000 a year in dividends alone, and your portfolio would be worth $1,082,373. I know this stock sounds great, but how do you actually find one like it? Well, it's easier than you might think. To start, you need to understand the different investing strategies, because if you want to win at investing, you've got to have a game plan, and that's what we'll explain next. First things first, you need to match your strategy with your financial goals and risk tolerance. Are you investing for a down payment on a house in 5 years, or are you thinking long-term, like building wealth for retirement in 30 years? The answer to that question will determine how much risk you're willing to take. For example, if you're planning on buying a house soon, you might not want to go all in on super stocks whose prices are very unpredictable. But if you've got a retirement plan, you can afford small investment amounts and stable stocks that over time would compound your wealth. And dividend stocks are actually ideal for this strategy. A common strategy is to diversify your investments. This means you don't put all your money into one stock, which helps spread out the risk. You might have some stocks, some bonds, and maybe even some real estate investments. Diversification is basically choosing not to put all of your eggs into one basket. Because if one egg cracks, don't worry, you've got others to fall back on. Now, when you're just starting out, you might feel a little overwhelmed by all the different strategies. That's totally normal. The good news is, you don't have to be perfect. One simple strategy you can try is dollar cost averaging. This is where you invest a fixed amount of money, let's say $10 a day, regardless of what the market is doing. It takes the emotion out of investing and helps you avoid trying to time the market, which is really hard to do successfully. So whether the stock price is high or low, you are investing the same amount. Over time, this can help you buy more shares when prices are lower and fewer when they're high, leading to a lower average cost per share. I should point out, one of the biggest misconceptions about dividend investing is that it's only for retirees or people who need income right away. Not true. Dividends can benefit investors of all ages, not just retirees. Think about it, dividends are a great way to grow your wealth automatically over time. When you reinvest your dividends, you're buying more shares without having to do anything extra. This process is known as dividend reinvestment, or DRIP, and it can supercharge your returns. Before we dive into specific investing strategies in detail, it's important to remember there's no one-size-fits-all approach. Your strategy should reflect your goals, your risk tolerance, and your investment horizon. With a solid strategy in place, you'll feel a lot more confident in your ability to navigate the ups and downs of the market. To make it easy for you, I've already handpicked a portfolio of stocks. In the end, I'll reveal this portfolio, which can turn a $10 daily investment into a $3 million portfolio valuation that'll pay $5,000 in monthly dividend income. Now, if you're not a fan of hassle, then you can just follow the best in the investing world, Warren Buffett. He's probably the most famous investor in the world, and he made his fortune by following the principles of value investing. Buffett bought $1 billion worth of Coca-Cola stock back in 1988. Over time, the dividends from Coca-Cola have been reinvested, growing his wealth exponentially to $25 billion. And today, it continues to pay him massive dividends of close to $1 billion every year. Warren Buffett's strategy is all about buying high-quality, dividend-paying companies and holding on to them for the long term. Simply put, value investing is about buying stocks that are currently undervalued by the market. The key to value investing is patience. You're not looking for a quick flip, unless you're trying to day trade, which can be risky. You're looking for companies that are trading below their true worth. These are companies that have solid fundamentals but are temporarily undervalued for one reason or another. Maybe the market has overlooked them, or there's some short-term issue that'll eventually pass. But how do you find these diamonds in the rough? The first step is to understand the business behind the stock. After all, you wouldn't buy a car without looking under the hood, right? Well, investing in a business is pretty much the same thing. You need to research the company's revenue streams, profitability, and overall long-term sustainability. This ensures you're not just betting on a stock price, you're investing in a real working business. Start by taking a deep dive into how the company makes its money. Is it relying on just one product or service, or does it have a diverse set of revenue streams? Take Apple, for example. Their iPhones are a massive resource of revenue, but they also make money through services like iCloud, the App Store, and Apple Music. This diversification can be a safety net if one part of the business takes a hit. Similarly, Tesla has multiple revenue streams tied to its cars, energy products, and even regulatory credits. Understanding how these revenue streams contribute to a company's profits helps you analyze its financial health and growth potential. Next, look at the profitability of the business. Is it consistently turning a profit, or is it in the red? Check out the income statement for key figures like gross profit, operating income, and net income. For example, Tesla's net income has been growing steadily, indicating that it is successfully scaling its operations and reaching profitability. But even a company with high revenue might have poor profitability due to high costs, so look beyond the top line and dig deeper. Another thing to keep in mind is the business's competitive edge. Does the company have a unique product, service, or market position that others can't easily replicate? Take Apple again. It's not just about the products, but brand loyalty and the ecosystem they've built. People don't just buy Apple because it's a phone, they buy it because of the entire Apple experience. Understanding these advantages will help you access whether a company can maintain its dominance in the future. When researching a company, don't forget to also check out real-life case studies of successful businesses. Look at how companies like Apple, Tesla, or Amazon built their businesses and managed their challenges along the way. Those examples can give you a lot of insights into the decision-making and strategies that have worked for big players in the market. The last step in value investing is buying at the right price, which means ensuring you're not overpaying for a stock, even if it's a great company. Let's break this down with some numbers. Let's say a stock is trading at $50 per share, and the company's annual earnings per share, EPS, are $5. The price-to-earnings ratio in this case is calculated as $50 divided by $5, which equals 10. This tells you that investors are willing to pay $10 for every $1 of the company's earnings. To determine if the stock is undervalued, you compare this with the industry average PE ratio. If the industry average is 15, the stock might be undervalued. However, if the industry average is, say, 8, this stock could be overvalued unless there are compelling reasons to believe it has exceptional growth potential. Another key metric is the price-to-book ratio, PB ratio, which compares the stock price to the company's net assets, total assets minus liabilities. Let's say the company's total book value is $1 billion, and there are 20 million shares outstanding. the book value per share would be $1 billion divided by 20 million, which equals $50. If the stock is also trading at $50, the PB ratio is $50 divided by $50, which equals 1, meaning you're paying exactly what the company's net assets are worth. A PB ratio below 1 would indicate you're buying the stock at a discount relative to its assets. Combining these insights, if a stock has a PE ratio of 10 below the industry average of 15 and a PB ratio of 1 fairly valued by assets, and you believe in its long-term growth potential, then this could signal a good buying opportunity. By analyzing these metrics, you can make informed decisions and ensure you're not overpaying even for a fundamentally strong company. As you can see, value investing is more of a hands-on experience. Next, we'll cover a strategy that's more of a hands-off experience requiring less effort on your part. Passive investing, a strategy that's become incredibly popular in recent years because it's simple, low cost, and effective. Passive investing involves buying investments that track the overall market or specific sectors rather than trying to pick individual stocks. The idea is that over time, the market will generally rise, and by investing in a broad range of assets, you'll get solid returns without the need to constantly buy and sell individual stocks. The easiest way to get started with passive investing is through index funds and exchange-traded funds, also known as ETFs. These are types of investment funds that track specific market indexes, such as the S&P 500, which includes 500 of the largest companies in the U.S., the Dow Jones Industrial Average, which tracks 30 major U.S. companies, or the NASDAQ Composite, which focuses on technology-heavy companies. There are also international indexes like the FTSE 100, which tracks the top 100 companies listed on the London Stock Exchange, and the MSCI Emerging Markets Index, which covers companies in developing countries. When you invest in an index fund or ETF, you're essentially buying a small piece of each company included in that index. For example, an S&P 500 index fund gives you exposure to a wide range of industries, from tech giants like Apple to consumer staples like Procter & Gamble. This approach offers the easiest way to diversify your portfolio without the need to pick individual stocks, reducing risk while still participating in the market's growth. Whether you want exposure to the broader market, specific industries, or even international markets, there's an index fund or ETF out there that fits your needs. One of the big advantages of passive investing is the low fees. Unlike actively managed funds, which have higher management fees because they're constantly buying and selling stocks, index funds and ETFs usually have lower fees since they're just tracking the market. Over the long term, these savings can add up and really boost your returns. Let's look at an example of an ETF, like the ProShares Ultra Pro Dow 30 with the ticker symbol UDOW. This ETF tracks the performance of the Dow Jones Industrial Average, which is made up of 30 major U.S. companies. The beauty of investing in this ETF is that it gives you exposure to all 30 companies without you having to individually pick and manage each of those stocks. Here's how this ETF could grow your and John's money over the long haul, assuming you start with a $10,000 investment and reinvest your dividends. This ETF has a dividend yield of 0.79%, meaning you'd earn around $79 in dividends in the first year if you started with $10,000. Over time, as the share price increases by an average of 20.41% annually, your investment grows not just from dividends, but also from capital appreciation. Plus, with a 10-year dividend CAGR of 27.63%, the dividends you earn will grow significantly each year, giving you more and more to reinvest. I'll dive deeper into how this works and the power of reinvestment later in the video, but for now, just take a look how the passive strategy could lead to massive returns over time. After 1 year, your portfolio would be worth $12,120. After 10 years, your investment could grow to about $70,181. After 20 years, you might be sitting on around $539,467. And after 30 years, your investment could be worth a massive $4.96 million. So why should you consider passive investing? Because it's simple, effective, and low maintenance. It's a great option if you don't want to spend your time picking stocks or following the market every day. By investing in index funds and ETFs, you can achieve solid long-term growth without needing to be an expert. It's a fantastic strategy for beginners or anyone who wants to build wealth while keeping things as low stress as possible. Now, some of you might want a little risk in exchange for potentially big rewards. For that, the best strategy is known as growth investing. This strategy is all about finding companies that are growing fast and have the potential for explosive gains. The idea is that you're not looking for a quick paycheck in the form of dividends. Instead, you're hoping that your investment will appreciate in value as the company grows, often at a much higher rate than the market average. Think of it as betting on the next big thing before it hits the mainstream. But it comes with higher risk because the companies you're investing in may not have a long track record or a stable revenue stream. These companies are usually in the booming phase of their business cycle. While some of these companies may skyrocket, others could fall. So it's definitely a higher risk, higher reward game. But how do you find the right growth stocks? Well, first you want to look for companies that are growing their revenues and profits rapidly. These companies often reinvest their profits back into the business to fuel further growth, which means they may not pay dividends. That's okay though. Your reward comes from the increase in the stock price over time. Next, look for companies in industries with high growth potential, like artificial intelligence, clean energy, or e-commerce. Let's take a look at a real-world example of growth investing with Visa Incorporated. Over the past few decades, Visa has been one of the top-performing growth stocks thanks to the explosion in digital payments. And if you would invest in Visa today, your $10,000 investment could grow to over $1.4 million. That's the power of growth investing. Find a company with solid growth potential, then let the market work its magic. Now, don't expect these kinds of returns every year, and certainly don't expect them to come without some ups and downs along the way. Growth stocks can be volatile, and there will likely be periods where the stock price fluctuates. That's why growth investing is better suited for those with a long-term outlook. You need to be patient and willing to hold on to your stocks even when the market gets choppy. But if you choose the right companies and ride the waves of the market, growth investing can lead to big-time rewards. So, how do you read the market to make a profit from it? Well, that's our next stop. Let's dive in. If you've been watching the market, you know one thing is for certain. The market goes up, the market goes down, and sometimes it feels like it's just spinning in circles. This is volatility. But here's the thing, you don't have to shy away from all that movement. In fact, some investors make it work to their advantage. They use the volatility investing strategy, a strategy where investors actually profit from the ups and downs of the market. For sure, volatility investing can sound a little intimidating at first. After all, the market isn't exactly known for being predictable, and sometimes it can be downright unpredictable. However, for investors who understand how to take advantage of these swings, volatility can open up some great opportunities. The key here is to balance risk and reward, knowing when to act on a market dip and when to hold tight through a market rally. One of the most common ways to profit from volatility is by shorting stocks, which involves betting that a stock's price will go down. Here's how it works. You borrow shares of a stock from someone else and sell them at the current price. Later, if the stock price drops, you can buy the same shares back at the lower price, return them to the lender, and keep the difference as profit. For example, if you short a stock at $50 and the price falls to $30, you buy it back for $30, return the shares, and pocket the $20 difference. However, shorting is risky. If the stock price goes up instead of down, you'll lose money because you still have to buy the shares back now at a higher price. For instance, if the stock rises to $70, you'll have to buy it back at $70, losing $20 per share. That's why shorting is considered an advanced strategy and is best suited for experienced investors who understand the risks involved. Another way to profit from market volatility is by riding upward trends. If you can spot a stock that's starting to rally, maybe because of a new product launch or positive earnings, you can jump in and ride the wave for a while. But just like shorting, riding the wave requires you to stay on top of market news and trends. It's all about being quick and reacting to the market as it moves. The most important part of volatility investing is timing. It's important to recognize market trends and act quickly. But remember, while volatility can offer great opportunities, it can also lead to big losses if you're not careful. That's why it's crucial to manage risk and not put all your eggs in one basket. For those who are comfortable with the risk and have the ability to react quickly, volatility investing can be a powerful way to profit from market swings, but it's not for everyone. If you prefer a more stable, long-term approach, you might want to stick with strategies like value or dividend investing. That's what I do, and that's what I recommend for the majority of investors. Now let's cover how to analyze stocks, ETFs, or mutual funds using key ratios and metrics. When you're evaluating stocks, one of the first things you need to understand is how to analyze the numbers. It's like trying to figure out if your car's engine is in good shape by checking the oil, transmission, and engine light. Except here, you're checking things like PE ratios, dividend yields, and book value. Knowing what these ratios mean can give you valuable insights into a company's health, profitability, and growth potential. Let's start with two related metrics that go hand in hand: price per share, or PPS, and market capitalization, or market cap. Price per share is, of course, the amount you pay to buy a single share of the company's stock. It's a good starting point for evaluating stock prices, but it doesn't tell you the whole story about a company's size or overall value. This is where market cap comes in. Market cap is calculated by multiplying the company's current share price by the number of outstanding shares. It gives you an idea of the company's total market value and helps investors understand the company's size relative to others. Large cap companies like Apple or Microsoft are typically more stable but may grow slower. On the other hand, small cap stocks often offer higher growth potential but come with more risk. For example, Tesla is a large cap company with a high PPS, reflecting its dominant position in the electric vehicle market. Next is price to earnings, or PE ratio. This is a key metric to help determine if a stock is overpriced or underpriced relative to its earnings. A high PE ratio could mean that investors expect high future growth from the company. For example, look at Visa. Its PE ratio is quite high, around 30, reflecting investor confidence in the company's ability to grow. On the other hand, if the PE is low, it could suggest that the market is underestimating the company's future prospects, or maybe the company is facing issues. Another important ratio is the price to book, or PB ratio. This compares a company's market value to its book value, essentially measuring how much you're paying for each dollar of assets the company owns. For example, a PB ratio of 1 means the market values the company at its book value. If it's above 1, you're paying more than the company's asset value, and if it's below 1, you're paying less. For companies like Coca-Cola with a PB of 8.89, you're paying a premium on the assets, but it reflects the strong brand equity and market dominance of Coca-Cola. Next up is the earnings per share, or EPS. This is a key metric that tells you how much profit a company makes for each share of its stock. It's calculated by dividing the company's net earnings by the number of outstanding shares. EPS is important because it shows the profitability of a company on a per-share basis and is often used to compare the profitability of companies within the same industry. A high EPS generally indicates strong profitability, while a low EPS might indicate that the company is struggling. However, you should always compare EPS with other companies in the same sector to get a sense of performance. Another ratio that's part of EPS is dividend yield, a favorite for income investors. This shows you how much money a company returns to shareholders in the form of dividends relative to its stock price. Coca-Cola, with a yield of 0.31%, offers lower immediate returns but is often seen as a stable, reliable company that slowly grows over time. On the other hand, American Tower has a much higher dividend yield at 3.14%, making it a more attractive choice for those seeking passive income. But here's the thing, ratios alone don't tell you everything. You also need to look at a company's balance sheet and income statement to get a complete picture. Take a look at Home Depot's balance sheet. They've got a hefty debt load with $64.13 billion in total debt, but their revenue is sky high, sitting at $154.6 billion. That's where ratios like debt to equity and current ratio come into play, helping you figure out whether the company is over-leveraged or managing their debt well. In the end, these ratios are just tools to help you understand how a company stacks up to the rest of the market. You'll want to use them in combination with your other research, such as understanding the company's industry, competitors, and future growth plans. You've got to look at all the pieces to get the full picture. Now, for my projections, which I showed you earlier, I prefer 3 key metrics: dividend yield, 10-year annual share price average, and 10-year dividend CAGR, or compounded annual growth rate. The 10-year average annual share price appreciation measures how much a stock's price has changed on average per year over the past 10 years. While this metric focuses on capital gains, it's important to look at it in combination with dividends, as it shows how well the stock has performed in terms of total return. 10-year dividend CAGR tells you how much the company has increased its dividend on average each year over the past 10 years. A high dividend CAGR means the company is growing its dividend at a healthy rate, signaling a commitment to returning value to shareholders. So yes, studying a company in depth is good, but you also need to know where it comes from, meaning which sector of the economy is it from? Understanding how these sectors work and how they relate to the broader economy is like knowing all the different types of fruit in the produce section. Some are seasonal, some are staples, and some may be better for your health at different times. Each sector behaves differently depending on the economic climate, so knowing what's inside each one can help you make smarter decisions about where to put your money. There are 11 major economic sectors in the U.S., and each one plays a different role in driving economic growth. For example, the technology sector includes companies that focus on innovation, like Apple or Microsoft. This sector often performs well when the economy is growing, and businesses and consumers are eager to invest in new technologies. On the flip side, the utilities sector, which includes companies like NextEra Energy, is more stable, offering essential services like electricity and water. When the economy slows down, people still need their utilities, making this sector a safe bet for some investors. Consumer discretionary is another interesting sector, which includes companies that produce non-essential goods and services like Nike or Tesla. These companies tend to do well when the economy is thriving and people have extra money to spend on luxury items. On the other hand, consumer staples like Procter & Gamble or Coca-Cola provide essential products like food and cleaning supplies that people continue to buy no matter how the economy is doing. This makes them more stable and less impacted by economic cycles. Then there's the healthcare sector, which includes pharmaceutical companies, hospitals, and health insurance providers. The demand for healthcare is relatively rigid, meaning people will continue to spend money on medical care regardless of the economic climate. In fact, the healthcare sector has been growing rapidly, especially with an aging population and new innovations in treatments and technologies. But just like shopping for fruit, where you want to buy a mix of produce for the different tastes and benefits of each fruit, you need to diversify your investments across different sectors. It's all about risk management. If one sector is underperforming, another might be thriving. For example, while the financial sector might take a hit in a recession, the energy sector could be doing well, especially with the increasing demand for renewable energy. The key takeaway here is that understanding economic sectors helps you understand the bigger picture. You'll be able to spot trends, manage risks, and diversify your portfolio with purpose. So before jumping into any stock, always ask yourself, which sector does it belong to? How might this sector perform given current and future economic conditions? These answers will guide your decisions, and hopefully, you can plan for market volatility. Now, if you're a little confused with all this information, don't worry. I've got you covered. Later on, I'll show you and John a portfolio that will do all this tedious work for you and demonstrate how to convert a $10 daily investment into a $3 million portfolio that pays around $60,000 in annual dividends. So with the right plan in place, you just need to know where to invest. Then you can ride out the rough times and even profit from them. Because markets don't just go up forever. Eventually, there will be corrections, recessions, and bear markets. But here's the thing, they are temporary. The market tends to recover over time. That's why long-term investing is so powerful. If you can weather the storm, you'll be well positioned to benefit when the market swings back in your favor. It's not about predicting the next big dip, it's about staying consistent and sticking to your plan. Staying rational during market highs and lows is crucial. When the market is soaring, it's easy to get caught up in the excitement and fear of missing out, but remember, markets can't rise forever. The same goes for when things look grim. Don't panic and sell off your investments just because everyone else